What will be the shape of the private equity market in the future after the bubble in private equity has burst following the financial market crisis? Let's find out immediately with Heino Meerkatt. Welcome.
Thank you.
You're the senior partner at Boston Consulting Group in charge of the private equity topic. You're presenting today at INSEAD a white paper that you've co-authored with the IESE Business School. You're presenting today in the context of the 7th Annual INSEAD Private Equity Conference. Your conclusions, you say to begin that private equity today is in the midst of a perfect storm. Why is that?
I think the perfect storm from the inside of the industry is because of several factors. First of all, private equity lives from buying and selling companies. Today, nobody actually, unless you really need cash, sells company. So basically, there are hardly any transaction. Factor number one. Factor number two, selling companies is hardly possible. There is no IPO market. There are hardly any corporations who like to buy actually these days. That's the second factor. The third factor, whenever you have a firm that needs to refinance its debt, you won't find a bank who finances to similar terms. And the fourth factor, which is a more, I would say, insightful thing, is that the LPs, the investors into private equity, are mostly, I would say, over-allocated to private equity. So even if they would like to kind of give money to the private equity industry, they have to either say we have to increase our asset allocation or just ignore existing rules. So in these terms, I would say it's very tough times for actually private equity.
Beginning with your first point, which is that there are no sellers of companies out there, so private equity investors cannot invest in companies. We're hearing time and again that basically it's not a question of no sellers, it's a question of valuation. In other words, the sellers have not readapted their selling prices to the current environment because they know basically that their companies are worth more than what the market is saying they're worth.
I think it's a chicken and egg question. I think there is a common sense that the multiples, first of all, are significantly down than like 1 or 2 years ago. And secondly, I think the other factor is, let's face it, we're all in a crisis. Earnings are either 50% or 100% down. So basically, like the valuation, yes, it's relatively low of companies. But again, would you sell a company today if you won't have to sell it? Probably not. You would rather like to keep it and wait, unless you have to sell it, if you need cash, if you're in distress. That's why I believe the markets, the lead flow that we see these days comes more where there is, as I said, a distressed seller.
You do know, though, there's a bit of a debate as to whether private equity multiples, transaction multiples, had really reached a kind of bubble type of valuation in the pre-crisis. In other words, maybe we've gone too far the other way, but should we even refer to some of those transaction multiples as what buyers could have been reasonably expecting, or was there indeed maybe a bit of an exaggeration there? So that maybe the truth lies somewhere in between.
I think it's a good point. It's actually interesting. We did another study that the corporates paid a higher multiple on average than private equity. So I think the myth that private equity overpays is just not true. Corporates tend to pay much more. Why? It's very simple, because the corporate has synergies. So it has worked. But there's one factor, that is a debt multiple. And this was just an amazing bubble. I give you one anecdote. I was involved in a transaction, competitive transaction. Private equity bought it, let's say, for a factor of index 100. 4 weeks later, the banks offered to refinance this to a level of 115. So the debt multiples, and we own this, have basically been exaggerated. So there was a debt multiple bubble, not so much an equity multiple bubble.
So where do we go from here?
I think, as we wrote, there will be a shakeout. I think we were the first who spoke about this shakeout. I think many people in the industry talk about a consolidation. What means consolidation? Consolidation means less firms for the same cake, so to say. And why do we believe in a shakeout? First of all, if you look at the long-term historic performance of private equity, on average, private equity did not outperform public markets. You find other studies who say different things, but we did very sophisticated studies and compared cash flows, so it didn't outperform. But the interesting thing is, the top funds consistently outperformed that market. On the other side, there were consistent underperformers. If you are an investor, if you would have to invest hundreds of millions of money, would you these days invest into consistent underperformer? No. So there are other factors, like there are firms who have actually kind of very, like smartly looked at the, the bubble. They actually rather sold more companies than they acquired. Others really invested in the bubble, so to say. So these factors will basically drive, I would say, the decision of the LPs in the next 2-3 years, where they commit additional money. And again, if you're a consistent outperformer, if you have invested then a lot in the bubble time, you will find it tough to actually raise new funds.
Let's talk about the LPs for a second. Where do they stand? I mean, basically, I understand that there's about $1 trillion in capital overhang. In other words, money that's been raised for private equity deals by LPs to GPs that has yet to be invested. It was probably raised just before the bubble burst and never had time to be invested. That's generating 2% per annum management fees, which are lost for the LPs, and yet it's not going into new deals. Is there going to be pressure at some point to just give the money back to the owners of that money and say, we'll come back and re-raise the fund in a couple of years when the markets are open again? What do you see happening there?
Yes, of course. I think it's less than $1 trillion. It's probably more around 500 to 600 billion, but I think large enough number to be invested in the next 2 years at all. Yes, there will be, I would say, pressure on the fees, but not on average. I think again there are like very strong funds historically who were smart in the crisis, sold more firms. The LPs will rather stick to those GPs and say, we all know these will be the best vintage years from looking into the future.
Buying low, buying at the
buy
peak,
low, it's common sense. If you see the analysis, it's very close to common sense. Buy low, sell high. So, and we can now buy low. So again, there will be LPs who basically say, like, we give you the management fee, stay tuned, keep the team. We know you're the best people in the industry, and please, whenever it makes sense, invest. Having said this, again, there will be other funds who will, feel enormous pressure, where LPs will actually try to get out of their commitments. They might sell it, or they basically will tell their GPs, can we talk about reducing the commitment? Can we talk about reducing significantly that fee? That will also drive the shakeout.
Okay, but you're saying that LPs who are happy with their GPs are going to tell them, we'll wait, invest as you see fit. But can the private equity industry continue to deliver its historic rates of return when there is no more a debt market? Because some people believe that the private equity business model is to do a kind of leveraged financing, and that's where the returns are. When there's no more leverage to be found, can private equity continue to operate on a business as usual kind of basis? Or does it mean the end of the industry until the debt markets are really open again?
Yeah, let me take a very different perspective on this. The debt bubble was dope to most of to many, I would say, of the GPs. So many, took it and said, we can make great returns out of this. But if you think it through, I mean, if a large number of debt, who profits from this? Mostly actually the seller, because it's just meant that the acquisition prices went up, the debt bubble, so to say, and that money went to the seller's pocket immediately. So I think blaming it to the private equity, first of all, I think it's wrong. It's blaming it to sellers who said, I want to sell it to any price, irregardless of how much debt is in there. Secondly, I believe that in the old days of private equity, I would say 4 years ago, leverage levels were not that high, and there was also a consistent overperformance of strong performers in terms of creating operational value. So again, I think even without any debt, maybe little debt, there is space for private equity, for the top performing fund to say, we create actually operational alpha. So we having a better governance model, and we really don't care actually if there's a lot of debt or little debt. If you talk to those GPs, they have an interesting perspective. They say, if there is less debt, it comes back to really our capability of creating operational value, because those funds, those GP who can, like take on leverage, like they will not be there anymore. So for many of the GPs, there will be actually less competition.
One of the headings of your white paper is most private equity firms' portfolio companies are expected to default.
Yes.
How true is this? Are we really going to see a bloodbath of defaults, covenant breaches? I mean, we're starting to see it, but I mean, how bad is it going to be?
Let me distinguish two words that you mentioned: covenant breaches and bloodbath. Covenant breaches, yes. I think the 50% is even conservative. If I look at many GPs of their portfolio firms, I would say that it's more than 50% of the portfolio firms that we have in Europe, in the US, where there is a breach of covenant, serious breach of covenant. We are probably seeing 50% or even higher, depending on like how deep the crisis will go, where the equity is washed out. Yeah, this is a fact, I would say. Does it create a bloodbath? I hope not. But this is, I would say, one of the biggest issues looking forward. A bloodbath you get when basically kind of the debt, the people who own the debt, sometimes 30, 40 people who come into the room, some even don't speak English or they have very different interests. So if they don't agree on, let's restructure, kind of, as I always say, the right side of the balance sheet, then it could be a bloodbath. Then the management has to declare bankruptcy, insolvency, has to go to court, and then it's going to be like a hard hit for the portfolio firm.
And the global economy.
And the global economy. But and there's one advantage again of private equity, if the debt and the equity holders agree, and there have been some public examples, so I can quote them, Ferretti, Sanitec in Finland, where there has been an agreement, recapitalization, and for the firm, for the management, was basically, let's continue our business. So that is actually then much better if you would be kind of a publicly listed firm, where again there is much more difficult to have an agreement between equity and debt holders on the terms going forward. So it really depends on how these people, equity and debt people, sit together on the table and can actually agree on restructuring the right side of the balance sheet.
Heino Meerkatt from Boston Consulting Group. Thank you very much indeed.
Thank you.